on today's show, 3 questions. Number 1, what's up with the downgrade? Number 2, how much does it cost to raise a child? And number 3, is the housing market broken? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Jake.
I'm Taylor.
Didn't even plan that. Nailed it.
No,
You're pointing. You're pointing.
I was always going to go first. I wanted to go first on
You
that.
just knew. Yeah. Robbie-less show. First time in a while we've had a Robbie-less show.
Yeah. Different dynamic today. It'll be fun.
Yeah, we decided to give him a break. He is off gallivanting in Europe, so we wanted to give him a little break. Post St. George, by the way, living the life. We go to St. George as a team, and then he sails off to Italy right after. Taylor made a good point before we went on. He said, this show might make more sense to the layman's, but it won't be as high quality without Robbie. So, which is probably true. Okay, so I'm going to do my best Robbie impersonation. It will be a worse version. There is no chance I'm going to be able to give.
This is a very Robbie topic. Yeah,
this is a very Robbie topic, but I thought this was timely and pertinent to talk about because it's everywhere, all over the news, among all the other billion things that happen apparently every day. So May 16th, so this was just last week, Moody's Investors Service downgraded the U.S. to the credit rating from its highest level, down 1 tier. So for context here, there's, I think, some things to, Taylor, you said this again before we went on, like we can understand why there is some freak out, that people are nervous. It does make sense. But let me just give some context because this has been a huge topic. People are freaking out. What does this mean? So so there's 3 credit agencies, right, that rate mainly debt, right? They rate the credit rating, which is one of the biggest risks when it comes to debt, right? Is how high quality is the group you're going to be getting a loan from, basically, or giving a loan to. And so there's S&P, Standard & Poor's, there's Fitch, and then there's Moody's. So Moody's downgraded them just last week. But for context, Standard & Poor's downgraded them in 2011. I don't think people remember that or maybe even know that. And then Fitch in 2023 downgraded them as well. So this is the first time ever that all 3 major credit agencies have downgraded the U.S. debt below top tier. I'll stop here for a moment. Any just thoughts initially on this? Anything you're hearing or things? Have clients brought this up to you guys?
I haven't heard anything yet. It doesn't mean that there aren't people out there worried, but I think, I don't know, with my clients and specifically our clientele, where the vast majority are what we call asset accumulators, a large percentage of net worth is not going to be in the bond portfolio. And so it's not something that I feel like affects people on a day-to-day basis as much as like the stock price, because they're not as necessarily seeing the actual dollar fluctuation in their accounts when something like this happens.
Yeah, totally agree.
Great.
Jake, anything from you?
No, I haven't really heard about it yet. I don't know. This does feel, even though it's been in the news, I know a lot of financial websites and publications are talking about it. Whenever we talk about like credit scores and bonds and debt, I feel like that's a little more convoluted and harder to understand than even just like typical stock market is up, stock market is down, inflation is up, inflation is down. And so I wonder if this is one of those topics where it is important and there are people worried about it before maybe the average person just investing and trying to accumulate wealth. This is one of those things where it's like, I know people are worried about it. It's a little too complicated for me, so it's just going to fly under my radar a little bit.
Yeah, I think that's a good point. I think that's the main thing I would reference to, is that people probably have seen the headlines, but their probably first thought is like, I don't even know what this really means. And let's be clear, it doesn't mean it doesn't mean much, right? But let's explain what it could mean or why maybe people are freaking out. So again, we talk about debt. There are different risk factors when it comes to debt versus stocks, right? So one of the biggest things being credit. The credit worthiness of the, again, person you're lending to, which when you buy a bond, you're lending to that group, in this case, the government. So all this is basically saying is what Moody has said, and I'll give you the reasons that they've stated. But Moody's has basically said the credit worthiness of the U.S., we're now saying, is a little bit lower, right? It doesn't mean they're defaulting. It doesn't mean that they're still not paying out. It just means that they're like, this is not the top rated debt anymore. And they cited 3 main reasons, 3 big reasons. So number 1 is just the rising national debt, right? So this is things people get confused. The deficit is the year-to-year cash flow statement of the U.S. The debt is the balance sheet that we're so referencing. So the U.S. federal debt has surpassed $36 trillion, which is pretty wild.
It's a number.
It's a number. So there's projections, because we continually, since 1998, have continued to run deficits every single year. We just keep stockpiling debt. It's $36 trillion in debt. Projections, there are certain projections that are indicating that we'll be at 134% of GDP by 2035. So over the next 10 years. So again, Moody's is looking at this and projecting out and saying this is a concern when it comes to being able to service the debt. The other big thing that number two, they referenced was increasing interest payments. So higher interest rates have led to obviously the costs increasing on servicing the actual debt.
This is why some of the deficit has ballooned a little bit in recent years. That the interest portion of that debt balance is growing and it's become a lot. Yeah.
A decent amount for sure.
Yeah.
So, and then just the other thing that they mentioned is lack of what they're calling lack of fiscal consolidation. So successive administrations and Congress have struggled to actually fix the problem and reverse the trend. So again, they're looking at this and just saying this has been a problem for multiple presidents, multiple administrations, multiple decades. They're looking at these things as a rating agency. They would look at this no different than when they're rating the debt of a company. They're rating the debt of Apple, who releases bonds, or Google or whatever. They're going to look at these factors and say, what is the likelihood that this can continue and that you can continue to service this debt? And that goes into their ratings. So I think hopefully that helps kind of give some context of this isn't the end of the world. This doesn't mean, despite headlines you might see oh my gosh, the US is crashing and going under. It is something of note, something to keep an eye on. But again, I bet most people listening probably don't remember or don't even know that the S&P, Standard & Poor's credit agency, downgraded the U.S. in 2011. And what's happened since then? We've continued to grow and there's been, no issues.
That's the point that I would make without... Oh, go ahead, Taylor.
I was going to say, just to add to that and put context into this, because it's we understand the market being up or down, but these ratings doesn't make a lot of sense to us. Most of the time when you're an investor, you're really not going to be putting money into a government bond, right? You're going to be buying a corporate bond, which are bonds that are held within companies. And to be what's called an investment grade bond, you need to have, again, there's different rating agencies. They all have their own, but the most one would be a triple B rating, right? And so the U.S. government bond used to be a triple A rating, which was the best rating you could get, right? And this is just them going from triple A to double A. So it's not hey, sky's falling, this is the end of the world. In the corporate bond market, this is still well above what we would consider a investment grade rating.
Definitely. Yep. Good context there.
Yeah.
Jake, go ahead.
I mean, yeah, the point that I would bring up too is, of all those reasons that Moody's listed, which I think are valid concerns and people have those concerns, they are not new things to the U.S. government and our economy, right? This is them this has been happening for a while. Yeah, we're kind of getting used to some of this. And so this is just an independent agency rating, downgrading the U.S., but nothing is changing structurally with how the government is issuing debt or anything like that. This is just almost like a third party just saying, I think the U.S. is in a bit of a scary spot, maybe, right, is what they're saying, which doesn't actually change anything or mean that we're in a different spot than we were a week ago.
Yeah. Yeah, it's a good point. Yeah. One thing to note here, and then we'll hit this for a minute and then we can move on. But when we talk about, again, different risk factors of different investments, again, we're talking about bonds having this risk factor of credit rating or credit risk. What is usually on the other side of that coin is return, right? So simply put, a fundamental kind of foundational principle of investing is where there is risk, there should be what we'd call a premium, an expectation for higher returns. And so what we're seeing for multiple reasons, but what happened right after this was treasury yields went up. And one of the main reasons for that was because the credit rating was downgraded. Investors now expect higher returns on that higher risk asset, like government bonds. So what does that mean? Because that was right on the heels of this. And Jake, you said it earlier, this becomes convoluted, this becomes concerning. People are I don't even know what this really means. What does it mean with treasury yields rising? there's a lot of different factors here to consider, but think of it like this, or the impact that this can have. Treasury yields go up, so they're up over 5%. I think the 10-year treasury went up over 5%. There's an inverse relationship to bonds, bond prices, and yields. So what this means is people have been selling. There's been a sellout of government bonds. That can sometimes indicate investor confidence, again, in the US. The other thing that it does, just think about this from an investor, like dentists out there listening. If I can get 5% on yields on a bond that is still like pretty safe investment, even though, yes, it got downgraded, versus deal with the volatility of the market, that can have some massive implications of what's happening in the stock market. There's a big relationship there. The other factor that it happens, not even on Wall Street, but actually on Main Street, is treasury yields are highly linked to borrowing costs for the average consumer. So for all of us, right? So mortgage rates, cars, borrowing costs is for standard kind of purchases like that. Those go up, which can then impact consumer spending, which can impact the overall economic growth. Like this, to me, the treasury yields increasing is a bigger, it was a ripple effect, I think, partly because of the downgrade, but that's a far bigger concern right now to me than the downgrade of the credit. Any thoughts on there from you guys?
I think that's great.
I think it's great.
Sorry, Taylor, go ahead.
This one too better, Jake. You be one.
I know. Okay.
We're out of practice. Robbie's not here. That's all good.
Practice. We're learning this. Yeah.
Okay, Jake, go ahead.
Okay, I'm going. I'm the one. You're the two. Okay, we're doing this. Yeah, with yields going up, me personally, I do not know if you're buying government bonds, if you really are in any more risk than you were a couple of weeks ago of the U.S. government going under. So getting higher yields on that is, I would think, a good thing. Also, just education corner, Taylor mentioned most of our clients are, if you're an accumulator, still building wealth early on, you have a long investment time horizon. You may not be investing in bonds directly. I would say, though, most of us actually do have some exposure now, though, to government bonds indirectly through our high yield savings accounts, which is a big thing. So just quick education corner. If you're putting money in a high yield savings account, which have become really popular, I love them. I utilize one. Essentially what that bank is then investing in is they're taking your money, they're investing in treasury bills, they're taking a little bit off the top and giving you the rest, right, is what's happening.
Yep.
And so this would impact possibly high yield savings account yields and things moving forward. We will see. But yeah, I think a lot of us now are indirectly tied to this through our high yield accounts.
Yeah. So it does benefit savers to that point. If you're holding cash, to your point, Jake, because those high yield savings accounts are on a variable rate every single month, it changes as these yields go up. Yeah, that will go up, which is great, which again can impact and create volatility in the stock market, because naturally there's people out there thinking, although they should not, but we know this happens. Oh man, like maybe I'll pull out of the market. I can get 5% of my cash right now. That's guaranteed. I'll just kind of sit on that. Like that can have an implication of what happens in the market.
Or if you're a retiree who can lock in a 5% rate of return on your already accumulated wealth, that's a pretty good option. And you might see a lot of retirees just wanting to lock in that 5% and ride off of that.
Totally. So something to note, we'll have Robbie back here pretty soon. We can dive even deeper into this. I'm sure he'll have a detailed breakdown and history of what this means and going back to World War II and all that. But I think it is worthy of noting the economic concerns. We don't need to go too deep into this, but on top of all this, we are seeing numbers of consumer spending is starting to soften. We're showing I think there are some signs of a softening economy. So again, worthy of noting, but not worthy of completely changing your strategy in any way. Taylor, anything else you wanted to add on this before we jump in to your topic?
No, I was just going to say the thing that you're like, it's not like a red flag. It's just like a yellow flag. It's really what you want to monitor is in everything we've been talking about is just the immediacy. Like people aren't as worried about this because it doesn't affect them immediately. Right. But I think the bigger worry about the people that really understand it is like, what could this be a bigger indication of in the future? Right. And we don't know what that is, but we're going to start to see the ripple effects, because even though we are not immediately affected, most of us in our portfolios, by the change of this credit rating, right? It does affect the yields, and then the yields affect the borrowing, and then the borrowing affects our spending. And there's just going to be a ripple effect that happens from something like this, right? And it's just worth noting. It's worth monitoring. And, that's why you have 2 cents, right? For Matt to tell us along the way what's happening.
For me, no, yeah, me to host Robbie and us to tell us all the details. So, yeah, that's a great point. Okay, let's move on. Taylor, I think a pertinent topic as well for listeners out there. I know for us three for sure, but how much does it cost to raise a child?
Are you going to zag here, Taylor, and tell us it's not a lot?
You
Yeah,
know,
we have no idea. I haven't heard any of these data points he's going to bring up.
it's both yes and no. I think it's a lot, and it's also less than I thought. So it'll be interesting, this discussion. I just to kind of give it some background. I've been kind of obsessed with spending since our beginning of year meetings, which we've been doing, July through March or January through March of this year. And during that time, we really focus with clients on cash flow, right? What's their income, taxes, debt payments, spending. And it just feels like everyone's spending went up, year over year. I mean, Jake, you can tell me if I'm wrong, but it just felt like everybody is spending more money.
Get Jake going on this topic.
When you analyze hundreds of people's spending and you see trends, it's just interesting to like dive into the numbers and see some of the actual data across the country compared to just our small sector of successful dental clients that we work with, right? So I wanted to just provide some perspective to our clients and all of our listeners of like, okay, what on average does it actually cost to raise a child, right? And so specifically, this data is done every year and they update it. But there's an agency that looks at from 0 to 17, what is the total cost of bringing a child into your family and raising it to quote unquote adulthood. So before I like say anything, I just want to get your guys' guesses. Total cost over 17 years. What would you guys guess is that number?
This is pre-college, is that right?
College 0
Like
to
not paying
17.
for school.
Yeah. Ages
Did
0
they
to
did they give a criteria, Taylor, of like what things they're including in this or no?
This was total
cost, right?
Total costs on average.
I've heard in the past that it's somewhere in the range of $250,000 to $300,000 per kid. That's the number I have in my mind from like previous things I've read
Yeah,
or
I'm
other
with that. Yeah,
conversations I've
I
had.
would say similar to Matt.
Something in
Yeah,
that range.
somewhere around there. Yeah.
And I think that just ages us because I had this exact same thought. Because when I went to school, it was 250,000, right, to raise a child. So
Yeah, so it's way
the
more now.
education, and I was like, oh wait, I'm kind of getting old, right? Things have changed, right? Costs have gone up, and so now, as of 2024, that cost has raised. In that number, that was about like 2018's number was 250,000, but now it's up to 315,000. So in the last like 7 years, we've increased that by, what is that, $65,000. So on average from 0 to 17, it's about $315,000 to raise a child. And that is, if you want to break that down, what that's total. Well, annually, that's about $100, or monthly, just over $1,500 a month to raise a child.
You cut out there for a sec, Taylor.
Am I back?
Yeah, you're back. You were good.
So
we can do some editing.
Yeah, so I don't know if you guys heard those numbers, but total cost 0 to 17, 315,000. Annual cost 18,500. Monthly cost 1,500 a month. So when you hear that, what are your initial reactions?
Yeah, it's funny when you break it down monthly. I'm like $1,500 a month. Like that's probably true.
This changes though, right? Like I'm wondering like what constitutes this. Why I asked that is like, are you counting 2 to 3 family trips a year in that calculation, like as part of that cost, or how much sports are you involved
or housing,
in
even housing,
or housing, or how much are you like private education if you're paying for that? Like, and that's what I'm curious on. I feel like with a lot of these numbers, it can vary widely.
Yeah. So the white paper breaks it down. If you were to guess what is the largest individual cost adding or contributing to that, what would you guess that is?
Education. No, because food.
I was gonna say food.
Clothing.
Yeah.
Food's number 2. Matt already said it, so Matt's already circled it.
What did I say?
Housing is the number.
So you're counting housing in there.
Yeah, housing is included in this. Housing, of that $1,500 a month, it makes up 29% of it. So on average, it's about $445 per child more a month to house that child.
like get an extra room or something is what they're
So
saying.
if, you were in a 1-bedroom and then you went to a 2-bedroom versus a 3-bedroom, that's included, right? So 29% of that total cost to raise a child is going towards housing,
Got it.
right? Which is kind of interesting because if you look at housing, most of the time, housing makes up 30 to 35% of someone's spending, right?
Someone spend.
So it kind of is in line of what it costs to raise a child. About 30% of it is going towards increased housing,
Yeah.
right? And then the second cost at 18% is food. Then the next one is childcare and education at 16%. And then transportation is the fourth at 15%, right?
But there's no way to prove this, but this seems intuitive to me. I want to hear what you guys have to say. You might hear this and say, man, you spend 350 if I just don't have kids. Let's say young people out there thinking like, if I didn't have kids, like how much more can I invest or save or whatever? But wouldn't it be fair to say that those costs, it might be pretty equal? Because think about someone living in their prime earning years, not having kids, like, wouldn't they just spend that money elsewhere, traveling or like bigger, more extravagant trips and things like that? We say it's incrementally more, but I would argue, I think, again, intuitively, it feels like, is it incrementally more or is it just like reallocation of funds that would be spent anyway? Does that make sense?
Yeah. My
I
brain,
mean, I know there's studies out there. I think it's because Taylor's on a lag. It's because, go ahead, Taylor.
you got it. You're
He's on
one.
a lag.
You're one. I'm two.
Go ahead. Go
I'm
ahead, Jake.
one. I'm one. I think there are studies out there that show, actually, I know there are, that show married couples accumulate more wealth than single individuals. And this isn't just from combining two incomes. I think a lot of this comes from more of the intangible responsibility aspect of this too, where I think there's an argument to be made of like getting married spurs you on a little bit. You have another person to take care of and try to impress and build a life together. And I think this also extends to kids as well, where you bring kids in the equation. Yes, they are an added expense. I never worried about my budget ever before kids. Like I was always just fine. Since having kids, I'm like, oh my gosh.
It makes you more serious about life.
But yeah, like our spending has gone up, but also I do think does be like, okay, well, I need to provide a little bit more now. I'm working on, creating memories and doing different things. So I think, yes, kids cost a bit, but getting married and having kids, like you said, Matt, like if I didn't have that, I would probably just spend that money on more golf or more vacations or different things like that.
Yep.
So I think that's a good point.
You'd have more free time, so you'd spend more money.
Yeah.
Probably wouldn't be incremental. It would just be a reallocation of where the money goes. Go ahead, Taylor.
I love that you went there, Matt, because I actually ran a calculation. Hey, if I put this 313 away, right? So I figured, hey, you're going to have kids around 30, age 50, they're done out of the house. So if you didn't have the child, then you'd have 315,000 extra sitting in an account. And if you grew that for the last 15 years, by age 65, that's an extra $1 million of net worth. But no one does that. No one's like, okay, I'm not going to have a kid. So I'm going to allocate the extra funds that I would have had to have a kid and put it into this separate account. Like that's just not how life works. Right. So it's, people can hear this and be like, man, if I didn't have kids, I'd be saving so much money. And it's like, no, you just be spending more money. Right. 100%.
You'd just be spending it elsewhere.
You just be spending it differently. Your vacation budget would be going up and hey, teach their own. That's great. That does sound fun. Right. I tell
It
the
does.
spreadsheet answer is not to have children, right? That is not the spreadsheet answer. But it was hearing this number was kind of like eye-opening in the sense like, oh, 1,500 a month. That doesn't feel like a lot, right? It feels like it should be more than that. But then I realized I have 3 kids. And if you have 3 kids, well, that's $4,500 a month. And I'm like,
Yep. That's per
yeah,
kid, right?
yeah, that's per kid. So it's like, I do feel that. I do feel that
You
$4,500.
probably spend that on milk every month, right?
That's
Well,
true.
the other part of this I'd say is this doesn't, I think people hear that. I think it's probably a bit of a misconception when people hear the monthly numbers, bro. Like you take the total number and you break it down monthly, depending on the stage of life you are in with your kids, that are either going to seem super high or super low, because this doesn't happen linearly, right? My kids right now at 6 and 4, my daughter will be 6 soon. at 6 and 4 are nowhere near as expensive as some of my clients or my siblings or my friends who have kids at like 16, 14, and 12. Like that is far more expensive. Just a simple example. My son just had a birthday. He is so cheap to have a birthday for. Like the presents you get him, it's like I can go to Five Below and get him like a Spider-Man little thing and he loves it. But by the time your kids get older, there's again, those presents are just like things that you want to do for them become more expensive. Traveling becomes more expensive. I can take my kids to a restaurant still and share a meal with them.
Activities become more if you're on a travel sports team or whatever, that becomes a lot
Sports
of
and all
extra
that.
expense. Yeah.
So it's not, I don't think it's not linear. I think you're going to see a bulk of that spending happen later on in their life with you as they become teenagers and in high school. I think high school and that stage of life with kids is the most expensive time of life for most people.
I don't think what was listed there, Taylor, on the breakdown were insurance costs. Like I think one of the big ones is you're adding kids to health insurance, which for most of our
Car
dentists or our
insurance when they
practice
drive.
owners, if you're adding more kids and family members onto your health insurance costs, that'll be at least a couple $100 a month.
Yeah, healthcare was 9%, which includes the cost of insurance, which is about $140 a month per child.
It's going to be more than that, sounds like.
Feels like it.
Yeah.
But okay, while we're talking about this, I've got one hack I want to share. This works. So I saw this on social media a while ago and I tried it. And let me tell you guys, you guys should do this. And everyone out there listening, I can't even remember where I got this from, but one of the biggest expenses I've found with kids is if you take them to the store, right? And the battle that ensues around them, like seeing, 50 things they want. And just even if it's not expensive to your wallet, it's expensive to your emotional well-being because you're battling them the entire time. So I saw it again somewhere a while ago, this little hack, and it works. You tell your kids, and it depends on the age, by the way. So this works for my kids for sure. So I did this probably a year ago, and they've never forgotten it. But on our way to the store, we were going to Target, and I said, "Hey guys, Dad got kicked out of Target. He's not allowed. He's not allowed there. So workers can't see me when I'm there. So you guys have to be my eyes and ears and be my special agents when I'm there because I still need to buy some stuff. And so you need to be my lookout." Every single time we go to the store, they're like, "Oh, Dad, you're not allowed." We literally go, and the entire time they're focused on spotting people in red shirts and playing that game. They've never once asked for anything ever.
They're going to grow up and be like 13 and tell their kids, like, my dad actually one time got kicked out of Target.
Exactly. Oh, it's pretty funny.
That's good.
It works.
Young parenting is just creative lying. And the more creative
it really is,
the better you
can. It's so true.
What about bargaining? I feel like I'm bargaining my entire life.
The entire time. Bargaining, creative lying. Yes, it's so true. Negotiation. It's just all that. I'm literally reading negotiation books of like how to negotiate with my kids, but we digress. Okay, let's move on.
One thing I wanted to just like tie a bow on this though is like these numbers, the 313 or the 18,000 a year or 1,500 a month, like that's the average. But I'd say for our clients, that's not the average at all. And I actually see well above that to several things that you've pointed out, Matt and Jake, of like, hey, if you go to private school or if you're in a travel baseball team or if you want your kid to insert whatever it may be, like I want to take them to Hawaii, like those are all discretionary things. And I think, a lot of times when we talk to people, they don't think they're discretionary, right? And I think it's important for people to realize what truly is discretionary and what isn't, because, you will sit down with someone who is objectively spending too much money relative to their income, and they'll look at you and they'll say, hey, I don't know how I can cut costs, right? And I think it's important to realize that, like, on average, costs $450 a month more to house your child. So when you're thinking of going from your $4,000 a month mortgage to the $15,000 a month home, right? That's not because you had a child, right? That's because you want to upgrade your house, right? You want to move into that demographic. We can't blame that on the children, right? It truly is.
But they will. It's for the kids.
Yeah. It's a choice that you are making, right? It's not for the kids. It is for you. right? And a lot of this spending is a lot more discretionary than we care to admit, right? And the private schooling, the type of daycare, the clothes that you buy for your kids, right? While you have to do those things, right? How much you do on each of those things and the type of education and the types of camps and all of those things are discretionary, right? And sometimes if we are spending too much money, we need to have a, hard look in the mirror and say, hey, is it okay if we don't do insert XYZ, right?
Yep. Such a good point, Taylor. And don't ever tell me if you're buying a $3-4 million house that you're doing it for the kids. I promise you, your kids do not care. That is for you. That is just own it. It's okay. By the way, it's okay. We like Jake, we said on the show recently, spending's not evil, but you don't need to blame it on your kids to buy something that you want. That's okay. They don't care about your car. They don't care about your house. They want time with you. So if you say I'm doing this for the kids, it's just not true.
Yeah. Agreed.
Okay. Jake, anything else? Taylor, anything else on that? Cool. Let's move on. Last topic. Jake came out hot with this. I asked for your question as we started, and you just had this locked and loaded. Is the housing market broken?
Maybe. It might be. Let's get into it. First, let's just zoom out for a second here. I know, Matt, you talked about, we're seeing spending in the economy, maybe the economy's softening a little bit type of thing there. I think if we look at a few broad numbers, the economy's still in a okay spot. Like if we look at unemployment rate is at 4.2% is the most recent number. We had a brief stint, like that's crept up a little bit over the past 6 to 8 months or so. We were really, really lows. Now we're at 4.2. You have to go back to the years 2000 to get another like low 4 range. And then before that, you have to go back to like 1970. So like unemployment is still really low. Everyone has a job. Inflation has cooled down to 2.3% is the most recent number, which is the Fed's target. So inflation is cooling down. Gas prices are pretty low. The stock market is still has recovered from that crazy March, and we're at like 12% year over year. So if I'm just looking like broadly speaking, if you're taking a snapshot of the economy and you can get 5% on yields, like we talked about, if you want to sit in cash too, not only can you make money in the stock market, but you can get a lot of money in your cash. These are kind of like what you would want out of your economy. Low inflation, low unemployment, stock market's doing well. You can get yields. Anyway, things are pretty well. But I think when you ask people who are still like concerned about the economy, they're like, I still feel dissatisfied. This doesn't feel good. I think a lot of it comes back to housing. I really do think that's like the underlying people are like, well, what about housing costs? What about interest rates? That is still it is still really, especially with young people too, right? It's still like one of those things where like, well, housing just doesn't feel good. And I think that's influencing a lot of how people feel about everything. So, which I think is right. I'm going to get into some numbers here. I always like to be the positive person on here. I feel like sometimes people may get annoyed at how I'm always like, it's going to be
For
fine.
sure.
Yeah, I know Matt gets really bugged, but there's some pessimistic housing numbers that I wanted to bounce off of you guys. So let's start with just the median monthly mortgage payment right now in America. Any guesses? Median new, so not existing. It's like new, if you're getting a new mortgage.
New
So
mortgage
this is
median.
not people who bought 10 years ago with like a 2.5%. This is like new median mortgage that you're getting today, median cost.
New is much higher than what I would have guessed otherwise.
Yeah, so new.
This is the midpoint for new purchases. I'm going to say it's got to be somewhere in the $3,000 range, 4,000.
I was going to say 3,500.
Yeah, you guys are spot on. It's $3,000. It's just under $3,000 is what the median mortgage payment is in America right now. Did you know that is more than double what it was in 2022, just 3 years ago?
Whoa, that's
doubled,
wild.
Doubled in 3
Which
years.
I guess makes sense because since then rates have doubled. So
yeah,
basically in lockstep, right?
Rates have been the biggest thing out. So that's like a huge spike. Like I have a chart here, which I'm looking at where we're pretty consistent. Like it stayed pretty consistent over for like much of this century. And then it's doubled over the past 3 years. So we've gone from like, $1,500-$1,600 medium new home house payment. We are now at $3,000, which is quite a bit.
Yeah.
Another data point with that, a reason for that you guys mentioned is interest rates have gone up. Did you know, again, that Torsten Slok is the guy's name? He just
good
recently,
old Torsten. Yeah. Yeah, good old,
It's
I call him
anyway,
Thor, but yeah.
yeah, tours anyway, it's this guy who publishes all these graphs about the economy. He has a huge one on housing where he has like 120 like housing graphs, and I took a lot of this data from him. Anyway, there's one chart that's fascinating, which goes back to like 1980, and it shows here's the 30-year mortgage rate and where it's at of like, and it shows the graph of like how that's trended over time. And then it shows here's the actual effective rate that people have on their mortgages. Like, so here's the rate that you can get right now if you're to buy a house. And here's the rate that people are actually paying on their houses. And throughout the past 50 years, they're pretty much the same always. Like they're always the same thing. Like, except there's a huge difference in this graph going back to about 2022, where now the average person, the average mortgage rate in America is under 4% is the average mortgage rate. And
That's a
in the
good
market
rate.
right now, it's like 6.5 is
Yep.
what you can get. That is the biggest discrepancy we've seen over the past 50 years in like interest rates of what people actually have as their housing rate and what you can actually get in the open market. So I think that's a big part of this, right? Rates just shot up. We may have fumbled that a little bit of just like this rate thing killed a lot of things. Taylor, go ahead.
So like, we had these historically low rates that were just like unheard of rates, historically speaking, and now we're to normal rates and they look bad in comparison, but it's like, honestly, historically speaking, a 7% on your mortgage is not bad at all, right? It's just bad when you compare that everybody refinanced 5 years ago.
Almost 60% of all mortgages in the US are under 4%.
That's wild. I mean, we have
Yeah.
clients that are in the twos.
So that's like the big discrepancy here that's happening. And here's another crazy stat. Did you know that 40% of all homes in the US don't even have a mortgage? 40%
That's higher than I would think.
are paid off. That's gone up in recent years over the past decade too.
Whoa.
So because of
That's
this,
good,
there's like,
Ramsey.
yeah, everyone has a super low mortgage rate who has a house. There's a lot of people who have paid off houses. And so because of that, we've talked about this before, there is the supply for housing, just no one's moving. No one is selling, they're staying. Go
Well,
ahead,
and
Matt.
think about this. It's so interesting, Jake. So there's the actual like market dynamics, like you said, where people aren't selling because why would you? There's the dynamics, the ripple effect still of 0809, where a lot of the builders in the country were left holding the bag. So that's made them actually like pretty hesitant to continue to build. I have two people close to me in my life that are both home builders, and like they're always they're always on edge of like they're going to be the fastest to react to stop if there's any worries because of what happened in 0809. So it leads to this dearth of homes, right? Where we have a shortage of homes, no one's selling. But the other part of this, that as you say this, Jake, it's kind of interesting is think of the psychological impact on two levels. So Taylor, you already alluded to one being the anchoring bias, right? And we're anchored to those low rates. So right now it just feels like horrible, even though we're pretty dang close to historical averages. I
Mm-hmm.
think 6% is pretty average for a mortgage over the last 50, 100 years. But the other part, Jake, that you're saying that this kind of just hit me as you're saying this is like kind of this like comparison. So it's like if you're a first time home buyer or like, somewhere in, late 20s, early 30s, mid 30s, and a lot of people who have rates in that 3.5%, 4%, and then you're sitting there trying to buy a house and you're like, oh, I'm 6 or 7. Like the psychological impact that has makes things feel way worse than they probably are.
Yeah, exactly. And the point of that too is because of this, I mean, this is why when rates go up, typically, that means house prices will go down, historically speaking. But the opposite has happened. We've had house prices go up because of this dearth of houses. There's not a lot of supply. And the demand keeps increasing because there's another chart that I have here which shows 33-year-olds are the most common age in America currently. It's like there are more
In home buying
33-year-olds in
age, yeah.
America than any other age group, which is prime home buying years. So we have the most people in America. So yeah, there we go. 33-year-olds, most common. The most people in the biggest demographics are in prime home buying years and want houses.
So the question is like, what fixes this? And this is going to sound bad, but truly, like, it's going to take. I think the general answer is time. But is this almost like demographic shifts? Like, do we just need the older people to? Let's be honest, we need older people to start dying. Like once they start dying, and then it opens up just through the demographic shift of like the baby boomers are the biggest generation in America still. And so they own, I don't know this, I don't have this in front of me, Jake, but I'd imagine they own the most homes because they have the most wealth.
70% of all home equity is the baby boomer generation currently. Yeah.
So there you go. So I wonder if just literally some time over the next 5-10 years almost shifts this, where it's like homes become like, we almost need to wait for older people to pass away to like open up homes, because home builders are not building enough to support the demand. It's just not happening.
I guess the answer to Jake's original question is yes, right? Is it broken? The
Is
answer
it broken?
Feels like a little bit.
Yeah.
For the first time home buyer especially, right? That's the thing, is the people who already have homes are kind of like, I'm okay. I have a low mortgage rate or it's paid off and I'm okay. And my house price has gone up. It's all of these 33-year-olds wanting to buy houses are like, how do I do this?
And I would qualify it as like, it's broken in the sense of the quote unquote like traditional American dream is kind of broken, because even if we look at, I mean, I don't know if this happens to you guys, but if you drive through old parts of town, the homes are really small, right? They're not like what we think of as homes today in the traditional new build sense. And so even when the baby boomers, quote unquote, pass away and there's all these homes that will be coming available, a lot of them are not homes that people want to buy, right? They're older homes, they're smaller homes, they don't have open floor plans, right? Like Joanna Gaines needs to get in there and knock out all the walls. You know, there's a demand for a certain type of home, which is being, completely underproduced. And then the affordability of these brand new homes is way too expensive. And so I just think we're going to see what's happening in Europe, right? Where if you look at most, you know, civilizations that have been around for thousands of years, right? Because the US is relatively young. Multifamily housing is going to become more and more prevalent, where people live in apartments, in shared communal living spaces, and that's what we're seeing being built, because that's from an affordability perspective and just from new modern amenities that people want, right? The old smaller home is kind of dying, and people don't want to buy those, right? And so demand is being produced at a smaller rate than we need, and the demand for things that are there is smaller because people don't want old; they want new. So it's it's broken. I don't know how it's going to get fixed. I just think the expectations of what we have when it comes to housing has to change.
There it is. Well, and so when you say, whenever I hear people talk about the traditional American dream is dead or is broken, that's probably true. But I think part of that equation is the expectations of what the American dream has changed faster than the progress we've actually made. Mm-hmm. To your point, Taylor, the young people today don't want the homes that young people 50 years ago were totally fine with and excited about. It's completely changed. We're talking about cost of a kid earlier. And one thing I thought of when we were talking about that was the expectations of like what a good year is when it comes to things like vacations. It is unbelievable. Even over the last 10 or 15 years, 20 years, I think, from when I grew up to what it is now is completely changed. So I think expectations and definition of what quote unquote the American dream is, I think it's more of a definitional evolution and drift than it is the American dream is dead.
I agree. Houses are getting bigger. That's a fact. So we actually are building bigger and nicer houses. I want to give you guys a few more pessimistic stats, if you'll let me. Just a couple more, then we can wrap up here.
Jake to be more of a pessimist.
The median age of first-time home buyers has increased from 30 to 38. It was 30 in 2008. It is now 38 today. Wow. Is the median age of first-time home buyers. It was 32 in 2020. It is 38 now, 5 years later.
So that, I think right there, that too is a huge factor, is how fast this changed. This changed so fast. I think the abruptness of it is probably where it feels worse, because I think you have a lot of people that, like, if you're talking 10, 20, 30 years, that's too slow to even like remember or to know. Mm-hmm. It's happened so slow. But because it's happened so quickly, you've got people who have friends who are in homes that they're now those same, or siblings, maybe it's an older brother, older sister, and it happens so quickly. Now all of a sudden it's like within a matter of 3 or 4 years, it's become completely unaffordable for those same people. I have empathy for that. That's brutal. That sucks.
Median age for all home buyers in 1980 was 30. It's 57 now. Yeah. 57 is the average age.
Wow.
Again, for some, to be fair here, we have an older demographic just of Americans now. The average American is 9 years older now than it was in 1980. We're just older now because we're having less kids. Baby boomers are huge, right? So we're an older generation. There are a lot more older people who are just trading houses
True.
with each other. So it's
Sure.
probably affecting these numbers a little bit. One last crazy stat. The median home buyer in 2007 was born in 1968. So 2007, the median home buyer was born in 1968. Today, the median home buyer was also born in 1968.
Holy cow. That is wild.
Yeah. Anyway, so we're going through all of this. I mean, it's harder and harder to get into a house. Like, if there's any part, I actually think our economy is in a pretty good spot. If there are a group of people who have reason to complain, I think it is the first time home buyers and the people looking for a home. Like, it is a tough place to be. I don't know how this gets fixed. I wonder, like, I'm curious, like, why this isn't a bigger political issue.
Yeah.
And I wonder if it's because all of our politicians are old and they have their homes and they like their home equity. I honestly wonder, like, this is a big young person issue, is housing. And I wonder if, like, again, like you said, Matt, what's the solution? Is it just time as we age more and these frustrated first-time home buyers get to a point where we start making some changes or things down the road? I don't know.
Well, not only that, Taylor, you made a good rebuttal to the idea of like, do we just need people like older people to die to open up their homes? That sounds bad, but like, just, it's just kind of like, is that what needs to happen? But the other part of this too, and then we can move on. This is a great
Sorry, I know this
conversation.
is meaty.
No, this is cool. The other part of that though, of like, again, do we just need time to go and like let the older generation kind of die off? I don't mean that, but I say that and it sounds really bad. But we've talked about this before, but the great wealth transfer. So a lot of these people that you're talking about, Jake, these 30, 33-year-olds, will most likely, based on the data of how much wealth the baby boomers are holding, when they die, there's like something like $80 trillion that's going to be inherited over the next 15 years.
Yeah.
I wonder what impact that might have on this. Maybe that is, again, that's going to be the answer. Is like these people just have to wait for, it's just
Yeah.
going to take time.
If you're
And wait for
mad at
death. Maybe the solution is death. That could be
if
it.
you're mad at the baby boomers, which I know there's a certain segment of people who are like, oh, arg, baby boomers, they got so lucky they bought their house for a penny and now it's worth a lot. If you're mad at them, the anecdote for that is you're going to get that money. It's coming to you soon. Like, that has to go somewhere. This would also be the argument for, if you are in the baby boomer generation,
Well,
help your kids out now. Help them out now. Right? Don't wait to transfer it upon death. If you can't help, maybe you can't, which I think is happening a lot, to be fair. I think a lot of people are getting help from family and older generations for housing currently, is why
Totally.
this house market's been propped up. Anyway,
Yeah.
Taylor, you can go ahead.
Finish this out, Taylor.
I was going to say, of that wealth transfer, the majority of it is not going, it's not evenly distributed. It's going to a
For
very
sure.
small percentage. So I think this problem still is not solved when people die, right? It's just going to be people who have successful parents and are in their own homes. They're just going to get better off. But the ones that are really struggling to get into a home, chances are they don't have a parent that's going to give them hundreds of thousands of dollars when they die, right? And it's still
Sure.
going to be for that first time home buyer demographic and those people that are trying to get just into entry level homes, right?
Yeah. And I don't know the data on this, but I think it could be safe to say, though, even those first time home buyers who are struggling, the likelihood of even their parents owning a home that they would inherit, I think is
Yeah, so
probably
that's the thing.
pretty
Like,
high.
if your parents have a home that's 10x in value, they're going to die and they'll get their home
Yeah.
equity or their house.
If they haven't
Yeah.
reverse mortgaged it and used it for healthcare costs.
Yeah,
Hopefully.
exactly. If they're not using it for retirement. Yeah, it's a good point. Okay, guys. Well, this is a great conversation. I think we held our own without Robbie. I'm hoping.
Sure.
We'll see. We'll get him back here pretty soon. I'm not actually sure when he's back. We might have another week without Robbie. We'll have to confirm that with him. But we've been doing kind of our closeouts with the Dentist Money Summit, but we're kind of done with that. The Dentist Money Summit. I will do my final one on that today. We would love to have you. We just got a message this morning from our team. We are getting pretty dang close to maxed out, like for real. Chip said that. So if you have any questions or you're interested still, check out dentistmoneysummit.com. We'd love to have you, Park City, June 20th and 21st. But what we want to start actually talking about is, again, now that the summit's coming around, this is on my mind recently because we just got invited out to Arizona to do a study club. This is something maybe a lot of people don't know, that we will and we love coming out to study clubs and providing education. So if you have a study club or a group of dentists that you want us to come out and talk to, let us know. You can go to dentistadvisors.com/study. We have topics on there, like really common topics that we go over. We can customize a topic for you. We'd love to come out and talk to your study club. So let us know. That's again, dentistadvisors.com/study. We'd love to come out. So Jake, Taylor, thanks for being here. Thanks for filling in with us for Robbie. Everyone, thank you for listening. That was our 2 cents. Till next time. Bye-bye.